Cole, yeah, we're seeing continued weakness with Nvidia, similar to some of the broad market weakness that we're seeing, despite some more conviction around this one from the analyst community. Stifel is boosting its price target on Nvidia ahead of its quarterly results. Those come after the close of trading tomorrow. They reiterate their buy rating. They're boosting their price target to 250. So that suggests more than 30% upside. The fundamental rationale here is that Nvidia is the backbone of AI infrastructure, and there are few analysts who would argue with that. In fact, when you look at analysts for Nvidia, the vast majority of them, more than 90% in the buy camp, and you've only had that one sell rating for Nvidia. The key message for Stifel is that they expect to beat on Q3 earnings, and they expect optimistic guidance for the current quarter, just reinforcing some of the short-term views that had been around Nvidia prior to some of this recent broad market weakness that we've seen, in particular hitting the tech sector. So they're expecting a moderate beat for the third quarter, citing just the historical cadence that the company has had. Now, we know even when they beat, it doesn't necessarily mean that the stock is going to move higher, even if it's a beat and raise, because there have certainly been some quarters where the stock still sells off despite that. He, again, anticipating optimistic guidance from Nvidia, key driver for the stock. They've had this massive, just confirmed long-term orders for their next-gen AI platform. I was talking to Garrett Melson from Natixis this morning, Nicole. One of the points that he made was that we kind of have an indication of how Nvidia will do based on its customers, because we know its customers, they've done well, so the expectation is that Nvidia will do well. We've heard comments recently from CEO Jensen Huang about how strong demand is. Stifel highlighting this as well. And then the growth opportunity in the total addressable market for Nvidia, they see that as strong. They're expecting it to be more than $100 billion exiting this year. But again, beyond that, they see it potentially approaching $1 trillion, Nicole.
All right. I mean, look, there's been a lot of optimism, as you say, when you think about how it trickles out. And you can see the customers and the deals that are happening. I think folks will be surprised if Nvidia comes in with something horrific.
It's true.
Anything could happen. I have no insight in.
With CEO Jensen Huang's recent disclosure of $500 billion in combined 2025 and 2026 orders garnering a lot of attention, Nvidia is scheduled to release third-quarter earnings on Wednesday. These orders, which represent ongoing demand in AI infrastructure, cover current Blackwell GPUs, Rubin GPUs for the upcoming year, and associated networking components. Analysts see this as an indication of perhaps $60 billion more revenue in 2026 than was previously anticipated, especially in the data center industry. Serving well-known tech companies like Google, Amazon, Microsoft, and Meta, Nvidia continues to dominate the AI processor market. Additionally, the business completed major investments, such as a $1 billion interest in Nokia to integrate GPUs into cellular network equipment, a $5 billion deal with Intel to improve chip compatibility, and up to $10 billion in OpenAI shares for GPU acquisitions. Nvidia's stock is trading somewhat below its late October level despite strong orders, which reflects market skepticism regarding hyperscalers' use of AI. With Q4 guidance forecast at $61.44 billion, and analysts expecting $1.25 EPS on $54.9 billion in Q3 revenue, Nvidia's sustained influence on the AI and larger IT sectors is evident. Top graphics chip designer, Nvidia is scheduled to release its financial results this Wednesday following the bell. Investors should be aware of the following. Last quarter, Nvidia reported revenues of $46.74 billion, rising 55.6% year-over-year, meeting analysts' revenue projections. Although the company's inventory levels increased, its earnings per share, EPS, above analysts' projections, making it a satisfactory quarter. Is it better to purchase or sell Nvidia before earnings? For current Edge members, read our complete study for free here. Analysts predict that Nvidia's revenue will expand by 58.1% year-over-year to $55.45 billion this quarter, which eyes a slower growth than the 93.6% gain it saw in the same quarter last year. It is anticipated that adjusted earnings will be $1.25 per share. Over the past 30 days, the company's analysts have largely reaffirmed their projections, indicating that they expect the business to continue on its current trajectory as it enters results. Over the last 2 years, Nvidia has consistently surpassed sales projections by an average of 4.7%, topping Wall Street's forecasts. Some of Nvidia's competitors in the processor and graphics chip market have already released their Q3 results, which gives us an idea of what to anticipate. Qualcomm reported revenues up 10%, exceeding projections by 4.6%, and Qorvo recorded year-over-year revenue growth of 1.1%, surpassing analysts' expectations by 1.9%. After the results, Qualcomm's stock price remained steady, but Qorvo's fell 7.7%. Concerns regarding the viability of the economy in 2025 have been highlighted by discussions surrounding potential tariffs and changes to corporate taxes. The group has underperformed overall, with share prices down 7.9% on average over the past month, while several processor and graphics chip stocks have performed well in this volatile environment. Nvidia is up 1.5% over the same period and is expected to report earnings at an average analyst price target of $232.79, up from the share price of $185.68 at the moment. The question of whether Nvidia stock can maintain its momentum is not relevant to Nvidia bulls. Instead, the primary concern on Wall Street is the stock's potential for growth. In light of that, Oppenheimer is offering some guidance. As earnings season approaches, there is a twist to the global financial institution's reaffirmation of its outperform recommendation on Nvidia stock. Oppenheimer now predicts the chipmaker will achieve $265, up from his previous projection of $225, because the company thinks the semiconductor giant is sitting nice. The present demand, the degree of visibility, and Nvidia's strategic position in the next phase of artificial intelligence form the basis of this analysis. According to Oppenheimer, Nvidia will outperform even the most optimistic forecasts. With earnings per share in the mid-$1 level, Wall Street is forecasting quarterly revenue of around $54 billion. Nvidia's CPUs are still a crucial part of data center building, where hyperscalers and AI firms are engaged in intense competition. Over the next 2 years, Nvidia expects its Blackwell and Rubin platforms to generate hundreds of billions of dollars in data center revenue. The true question is not whether Nvidia can relocate its chips given the current infrastructure and financial constraints, but rather how soon the current demand is converted into actual revenue. According to Oppenheimer, for demanding AI applications, the GB300 Ultra and the NVL72 rack platform continue to offer the best performance per watt. This is particularly crucial when energy expenses and power constraints increase. As long as rivals are unable to match Nvidia's blend of software, performance, and efficiency, its exorbitant prices are reasonable. According to Oppenheimer, Nvidia's AI total addressable market is worth more than $4 trillion. This number includes commercial customers, government AI projects, and cloud providers. China's potential is worth about $50 billion, but export limitations prevent it from being included in the main forecasts. Oppenheimer's $265 price target is primarily predicated on the idea that governments and hyperscalers, aside from those in China, will keep making significant investments in large-scale AI infrastructure projects. It is not unexpected that a number of bulls continue to line up in record numbers when you own a stock like Nvidia. With a price target of $230, Susquehanna is one of numerous analysts who, aside from Oppenheimer, think the joyride is far from finished, despite Nvidia's more than 1,300% 5-year gain. Oppenheimer is unique in that he predicts further upside based on the notion that AI growth will not slow down, while the consensus price target for the company is in the low 230s. Given that it supplies the hardware for the AI revolution, Nvidia will ultimately profit from these actions. However, because of the dire valuation outlook, some analysts may consider the Oppenheimer price objective a moonshot, not because they have doubts about Nvidia's future. Notable figures who have put out their own reasons contesting Nvidia's renowned value include David Solomon, CEO of Goldman Sachs, Michael Burry, founder of Scion Asset Management, and Jay Goldberg, semiconductor analyst and founder of Digits to Dollars. Oppenheimer's $265 price objective is notable in these conditions. Given Nvidia's performance to date and Jensen Huang's assessment that, where the two sets of analysts differ is in their assumptions, the wager makes sense. The Nvidia bull argument has received a lot of attention, but let's all take a moment to acknowledge the skeptics and detractors for a more comprehensive assessment. The first is the well-worn criticism of Nvidia, according to which the massive semiconductor company is incapable of producing as much growth as the stock's price indicates. Additionally, Nvidia's stock will decline if any of the following occur at any point, either simultaneously or all at once. If large corporations and enterprises believe they have enough AI capacity, demand may taper off. Nvidia's market share may be eroded by competition from AMD, Intel, and internal accelerators at major cloud providers. Nvidia bulls will continue to be concerned about geopolitical instability, even if the United States and China patch things up. These forecasts and assumptions should not be disregarded. If anything, astute Nvidia investors should bear all of this in mind when deciding whether to raise their ownership of the company or when starting a new position. Fundamentally, Oppenheimer's $265 target is an investment in the future. In my opinion, the verdict does not go to Nvidia. Rather, it is more of an assumption that the AI frenzy that drove the company to unprecedented heights in 2025 will continue, at least for the foreseeable future. The following must occur for the target to continue to be viable. Even if demand for AI slows down generally, revenue growth must continue to be strong through 2026, driven by Blackwell and Rubin. High margins must continue to give them a price advantage over rivals, especially AMD and Intel. In terms of size and diversification, Nvidia will be able to survive if China and the US upset the political balance. In the end, Oppenheimer's optimism will soon be tested, regardless of your stance on the matter. When the semiconductor business releases its most recent earnings on November 19th, we will be able to observe where Nvidia is going next. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Carl, yeah, here we go with another big AI deal. This one is involving Anthropic, Microsoft, and Nvidia. So let me tell you what's going on here with all the numbers. Anthropic is saying it's going to spend $30 billion in compute from Microsoft. That would obviously be through the Azure service, and Nvidia, obviously, through their GPUs and chips. And they're going to contract up to 1 gigabyte of compute power on top of that. Also, on top of that deal that Anthropic is committing to, NVIDIA and Microsoft are going to be investing in Anthropic, with NVIDIA saying they're going to invest up to $10 billion, Microsoft up to $5 billion. Now, no details on what that up to exactly means and what sort of performance metrics or what have you Anthropic needs to meet in order to attract that investment, but very significant here because, of course, Microsoft is the primary backer of Anthropic's biggest rival, OpenAI. So now we're seeing Microsoft starting to not only open up its computing platform to these other AI companies and AI models, which it's been doing for some time, but also investing in these rivals to OpenAI. This is a very significant moment with respect to that. And also, we should just talk about these Anthropic models are now going to be hosted on Azure. They've already had some limited partnership going on here between Anthropic and Microsoft. Now the latest and greatest models are going to be available through Microsoft's Azure cloud services, whether that's for developers and things like that, presumably also making their way into more Microsoft products. Now, guys, I'm out here in San Francisco because it's the Microsoft Ignite conference, and I'm going to be talking during Power Lunch with Microsoft's new commercial CEO, Judson Althoff, about this new deal, about all of that, and about how they're going to be leveraging some of these new technologies into their Copilot products, guys.
All right, Steve, we talk about the circular nature of many of these deals, and this certainly seems to fit the narrative. Again, I know you've outlined it for us. Now, NVIDIA and Microsoft are committing to invest up to $10 billion and $5 billion, respectively, in Anthropic.
Correct.
Last value for Anthropic, I believe, is $183 billion, at least the last time they raised any capital. Is this at a new level? Do you happen to know?
Yeah, they're not saying if this is at a new valuation or anything like that. And also, I'll just point out this $30 billion in commitment in spend from Anthropic. Anthropic's revenues are in like the low single-digit billions on an annual basis, I believe. So even less than what we've heard from OpenAI. So they would need to have quite an extraordinary growth rate, just like OpenAI is predicting, in order to meet this. And I will just again highlight this investment from Nvidia and Microsoft, David. It's a little loosey-goosey here. They're saying up to, and they're not exactly saying why or why not, they would go up to that amount. So presumably there are some metrics that Anthropic will have to hit to get that cash, David.
Right. And just to point out, so NVIDIA invests money in Anthropic. Anthropic commits to spending $30 billion with Microsoft. Microsoft buys NVIDIA GPUs to power the compute that is provided for Anthropic. So there's the circle to a certain extent.
Yeah, my head's spinning just hearing that.
Yeah.
The other thing, Steve, is how quickly that exclusivity with OpenAI, kind of these relationships are splintering in real time.
Yeah, that's exactly right. So we've been watching this it's like the longest divorce ever, right, Carl? Watching OpenAI and Microsoft slowly drift further and further apart, becoming less and less dependent on it. And to your point, yes, when they had that new agreement just a few weeks ago, OpenAI no longer has to go to Microsoft for the right of first refusal to get into Azure. We've, of course, seen them cutting deals with so many others, and now Microsoft is playing the other side of that. Pretty soon after that OpenAI deal, boy, they go right after Anthropic, lock down some revenue from that company. And by the way, Anthropic's playing around too. They just had a big data center open up with Amazon and AWS, and that is part of their cloud provider too. Obviously, Amazon is a big investor, and Google as well in Anthropic, guys.
Yeah, I mean, Steve, also Anthropic, we think of as being one of the leaders in the enterprise versus ChatGPT, more consumer. I don't know how you're viewing this, or obviously the additional capital, what that will mean, but it certainly does seem to heighten the competition at the very least between these two leading large language models.
Yeah, that's exactly right. And look, OpenAI is a Microsoft competitor, David. I talk to CTOs all the time. I was talking to one who was telling me this last week and saying, we're going with OpenAI because they move faster. They are able to put out enterprise products and things faster and better than Microsoft can. They use that Atlas browser as a really good example of that, saying, we would love to have a Microsoft version of an AI browser, but they can't do it yet because they sort of have to wait on OpenAI in order to develop it for the Microsoft customer. So seeing Microsoft kind of spread the wealth, so to speak, work with other models, it could perhaps help them move faster. And again, David, I'm out here at this Ignite conference because I'm expecting in a couple hours' time when Judson Althoff gives his keynote to kind of detail how these different language models are going to play into the Copilot product, which is what the consumer-facing side of AI for Microsoft. We know the cloud business is doing quite well, but we still haven't seen quite the fire and energy on the consumer-facing side yet.